Have you ever wondered how high-interest debt can silently drain your finances? In this video, we'll explore the true cost of carrying that debt versus the potential gains from investing. You'll learn why prioritizing your financial choices is crucial for your future. Spoiler alert, the average high-interest debt can cost you thousands over time. Let's dive in. Have you ever felt like you're stuck in a never-ending cycle of high-interest debt? Picture this. You've got a credit card balance of $1,000, and the interest is piling on at an astonishing 20%. That's $200 a year just in interest. Now, imagine if instead of paying that off, you took that same $1,000 and invested it in a low-cost index fund that averages 7% growth annually. In 10 years, you could have over $2,000. So, what's the true cost of high-interest debt versus investing? Is it time to prioritize paying off that debt, or can you afford to invest while you still owe? Today, we'll break down the numbers and help you make that decision. But first, if you find this topic helpful, don't forget to like, share, and subscribe to Chill Finance for Real Life. Your support means a lot. Before we dive in, it's important to note that this video is for educational content only. It is not financial, legal, or tax advice. We encourage you to do your own research and consider seeking professional advice if needed. Remember, understanding your personal finances is a journey, and we're here to help you navigate it. Alright, now let's zoom out and explore the true cost of high-interest debt versus investing. Imagine you have a credit card debt of $1,000 with an interest rate of 20%. That means if you don't pay it off, you could owe an additional $200 in just 1 year. That's like throwing money away. Now, let's think about investing. If you invest that same $1,000 and earn an average return of 7%, in just 1 year, you could grow your investment to $1,070. So, which comes first? Paying off debt or investing? It's a common dilemma. A good rule of thumb is to tackle high-interest debt first. Why? Because the cost of that debt can often outweigh potential investment gains. But what if you have a lower interest rate, say 5%? In that case, investing might make sense, especially if you can earn more than that in the market. Here's a quick recap. High-interest debt can be a financial burden, while investing can build wealth over time. Now, let's consider inflation. If inflation is around 3%, that means your money's purchasing power decreases over time. So, if you're not careful, even a good investment return might not keep up with rising prices. Have you ever felt overwhelmed by these choices? You're not alone. Many people find themselves at a crossroads, unsure of what to prioritize. Ultimately, the best approach is personal. Assess your situation. Are you carrying high-interest debt? Or do you have a stable financial foundation? Remember, the journey to financial wellness is unique for everyone. Take the time to understand your options, and don't hesitate to seek help if you need it. Thanks for joining me today on this exploration of high-interest debt versus investing. Stay curious, stay informed, and keep striving for financial clarity. Imagine you're standing at a crossroads. On one side, there's a path leading to high-interest debt, and on the other, a road to investing. Both choices seem appealing in their own right, but today, we're diving deep into the true cost of high-interest debt versus investing. Which should come first? Let's start with high-interest debt. Picture this. You have a credit card with an interest rate of 7%. If you carry a balance of $1,000, that debt isn't just sitting there. It's growing. In fact, after 1 year, you would owe $1,070. That's $70 added to your original debt, just for borrowing that money. Now, let's think about investing. If you took that same $1,000 and invested it instead, earning an average return of 7%, you would also end up with $1,070 after 1 year. Seems even, right? But here's where it gets interesting. If you keep that investment for 10 years, you're looking at a total of about $1,920, assuming you keep earning that 7% return. Meanwhile, that high-interest debt would have ballooned to around $1,920 as well. But what if you could pay off that debt first? Imagine you're tackling that $1,000 debt aggressively. If you focus solely on paying it off, let's say you put in $200 each month, you'd be debt-free in just over 5 months, saving yourself from paying even more interest. And then, you could shift your focus to investing. Now, let's consider the long-term picture. If you invest your money after paying off that debt, you could potentially earn even more. Over the next 10 years, if you invested that $1,000 and continued to add $200 each month, you'd be looking at about $22,000, assuming that same 7% return. So, what does this mean for you? It's all about timing and priorities. If you're drowning in high-interest debt, prioritizing that might be your best bet. But if you can manage your debt and still invest, you could be setting yourself up for a brighter financial future. Now, let's pause for a moment. Have you ever found yourself in a similar situation? Maybe you felt torn between paying off debt and investing for the future. Think about how you approached that decision. When considering whether to pay off debt or invest, remember that high-interest debt can be a financial anchor. It weighs you down, while investing is like planting seeds for your financial garden. The sooner you clear that debt, the sooner you can nurture your investments. All right, let's recap. High-interest debt can quickly spiral out of control, costing you more than you might realize. Investing, on the other hand, is a powerful tool for building wealth over time. But the key is knowing when to tackle each. So, what's your take? Are you leaning toward paying off that high-interest debt first, or do you feel ready to dive into investing? I'd love to hear your thoughts in the comments below. Remember, the journey to financial wellness is personal. There's no one-size-fits-all answer. Just like choosing between those two paths at the crossroads, your decision should align with your current situation and future goals. Ultimately, it's about finding balance. By understanding the true cost of high-interest debt versus the potential of investing, you can make informed choices that lead to a more secure financial future. So, take a moment, reflect on your situation, and decide which path you're ready to take. When we think about our finances, one of the biggest dilemmas we face is whether to pay off high-interest debt first or to invest our money. It's a tough choice, and today, we're going to look at the brutal math behind it. Let's use a consistent interest rate of 7% for our calculations. Why 7%? It's a common average return for long-term investments in the stock market. Using this rate allows us to compare the cost of debt and potential investment growth on the same playing field. Imagine you have a credit card balance of $1,000. If you only make minimum payments, that balance could take years to pay off. With a 7% interest rate, your debt will grow. Now, let's calculate how much you'll actually pay if you stick to the minimum payment. If you pay just $25 a month, here's how the math works out. First, we need to find out how much interest accrues each month. 7% annually means about 0.058% monthly. So, multiply $1,000 by 0.058, which gives you approximately 58 cents in interest for the first month. Now, if you pay $25, you'll subtract that from your balance. So, $1,000 minus $25 is $975. But don't forget that interest, which means your new balance is now $975 plus 58 cents. As you can see, that balance is still high. Over time, the interest continues to pile up, and you'll end up paying a lot more than just the original $1,000. Fast forward a year, and let's look at what you'll have paid. If you keep making those same payments, you'll pay about $300 in interest alone. That's right, $300 just to borrow $1,000. So, what if instead of paying off that debt, you decided to invest that $1,000 instead? If you invested with an expected annual return of 7%, you're looking at a different scenario. Let's calculate that. If you invest $1,000 at 7% for 1 year, you would earn $70 in interest. So, at the end of the year, you'd have $1,070. Now, let's compare the two scenarios. If you paid off your debt, you would have $0 in debt but spent about $300 in interest. On the other hand, if you invested that $1,000, you would have $1,070 after 1 year. That's a difference of $1,070 versus $0 in your pocket. But this is just the beginning. Let's take it a step further and look at 5 years. If you continue to invest that $1,000 at 7%, you would have about $1,415 by the end of 5 years. In contrast, if you continued making those minimum payments on your debt, you would still be paying off that balance and accruing interest. It could take you over 5 years to pay off that $1,000 balance, and you'd end up paying more than $600 in interest by then. Now, let's think about this. You could have invested that money and turned it into $1,415, while still dealing with a debt that cost you over $600. It's clear that high-interest debt can severely impact your financial future. But here's a quick recap. $1,000 in debt at 7% interest can cost you over $600 in 5 years. Meanwhile, investing that same amount could yield over $1,400. But here's where it gets interesting. What if you had $2,000 instead? If you invested that amount, you would see even greater returns over time. This brings us to an important question. Is it worth it to invest while carrying high-interest debt? The answer really depends on your situation. If you have high-interest debt, it might be wise to prioritize paying that off first. Think about it. Paying off that debt could save you hundreds, if not thousands, of dollars in interest over time. But if your debt is manageable and low interest, investing could be a smart move. So, what's the takeaway here? High-interest debt can be a financial burden, and understanding its true cost is essential. Before making decisions, consider your personal situation. Are you ready to tackle that debt, or can you afford to invest? I'd love to hear your thoughts on this. Have you ever faced the dilemma of choosing between paying off debt and investing? What did you decide? Remember, the choices you make today can shape your financial future. So, weigh your options carefully and make informed decisions. Meet Sarah, a 28-year-old marketing professional. Sarah had a credit card balance of $1,000 with an interest rate of 7%. She was paying the minimum each month, thinking it was manageable. But here's the kicker. With that rate, it would take her over 3 years to pay off the debt, and she would end up paying nearly $150 in interest alone. Now, imagine if Sarah had decided to invest that $1,000 instead. With an average return of 7%, in 3 years, that money could grow to about $1,250. So, while she was just paying off debt, she missed out on potential gains. It's a simple choice, but the impact is huge. Next up is Mike, a 45-year-old father of 2. Mike took out a personal loan for $10,000 to renovate his home. With the same 7% interest rate, his monthly payments were around $350. If he focused solely on paying off that loan, he would spend over $2,000 in interest over 5 years. But what if Mike had invested that $10,000 instead? In 5 years, at a 7% return, he could see that amount grow to over $14,000. That's a difference of $12,000 just by prioritizing investing over debt repayment. Now, let's meet Lisa, a 35-year-old teacher. Lisa has a student loan of $15,000 at 7% interest. She's been diligently paying it down, but with rising living costs, she's feeling the pinch. If she were to invest that $15,000 instead, in 10 years, she could potentially have over $30,000, compared to the interest she would pay on her loan. Here's a question for you. What would you choose if you were in Lisa's shoes? Now, let's talk about David, a recent college graduate. At 22, he has a credit card debt of $500. It sounds small, but at 7% interest, it can still grow. If he just paid the minimum, he'd end up paying about $70 in interest over 2 years. But what if David took that $500 and invested it? In 2 years, it could grow to about $600. That's a difference of $100 just by choosing to invest over paying off small debt. Finally, there's Rachel, a 50-year-old small business owner. She has a business loan of $25,000 at 7% interest. If Rachel pays it off quickly, she'll save on interest, but she's also considering investing in new equipment. If she invests that $25,000, In 5 years, she could see it grow to over $35,000. So, what's the takeaway? Balancing debt repayment and investing is crucial. It's not just about the numbers. It's about making informed choices that can impact your financial future. High-interest debt can feel like a heavy weight, dragging you down financially. Let's break it down. When you have debt with interest rates above 20%, you're losing money fast. For example, if you owe $1,000 on a credit card at 25% interest, you could pay over $250 just in interest in 1 year. That's money that could have gone into savings or investments. So, what's the true cost of that debt? It's not just the money, it's the missed opportunities for growth and financial freedom. Now, let's talk about investing. Investing is essentially putting your money to work for you. Historically, the stock market has returned about 7 to 10% annually, on average, after adjusting for inflation. If you invest $1,000 at a 7% return, in 10 years, you could have over $1,900. Isn't that a compelling reason to focus on investing? Alright, now let's zoom out and consider the bigger picture. Imagine you're in a race. On one side, you have high-interest debt, and on the other, you have investing. If you prioritize paying off that debt first, you're clearing the path for future financial success. But what if you could balance both? Paying off debt while also setting aside a small amount for investments can be a smart strategy. What do you think would be more beneficial in the long run? Here's a quick recap. High-interest debt can drain your resources, while investing can help grow your wealth. But remember, it's not just about the numbers. It's about your peace of mind. Reducing debt can relieve stress, allowing you to focus on your financial goals. Have you ever felt that weight lift when you paid off a debt? Next, let's explore the concept of opportunity cost. This is what you miss out on when you choose one option over another. If you're paying high-interest debt, you're missing out on potential investment gains. For instance, if you invest that $1,000 instead of paying off a lower-interest loan, you could be losing out on future earnings. Isn't it fascinating how your choices today can shape your financial future? Now, let's discuss the importance of budgeting. A solid budget can help you allocate funds for both debt repayment and investing. By tracking your expenses, you can find areas to cut back and redirect that money towards your financial goals. What if you could find an extra $50 each month? That could go a long way in either paying down debt or investing. Finally, remember that financial wellness is a journey. It's not just about choosing between debt and investing. It's about creating a balanced approach. Set realistic goals, stay informed, and adjust your strategy as needed. What steps will you take today to improve your financial health? Let's keep this conversation going in the comments below. Alright, let's dive into some common objections you might have about prioritizing paying off high-interest debt versus investing. You might be thinking, but if I invest, I could earn more than the interest on my debt. That's a fair point. Historically, the stock market has returned about 7 to 10% annually after inflation. But remember, high-interest debt, like credit cards, can charge you upwards of 20% or more. So, if you're paying that much in interest, you're losing more than you could potentially gain from investing. Now, let's pause for a moment. Imagine you have a credit card balance of $1,000 with a 20% interest rate. If you only pay the minimum, you could end up paying over $1,500 in total. That's money you could have used to invest. Another common concern is, what if I miss out on investment opportunities while I'm paying off debt? It's true that the market can be unpredictable. But think of it this way, every dollar you pay towards high-interest debt is a guaranteed return on your money. It's like earning 20% without any risk. And here's a quick recap. Paying off high-interest debt first can free up your cash flow, allowing you to invest more in the long run. So, what's your priority? Would you rather pay off that debt and secure your financial future, or take the risk with investing while still carrying that weight? I'd love to hear your thoughts in the comments below. Remember, it's about finding balance in your financial journey. Let's keep the conversation going. Have you ever wondered how high-interest debt can impact your financial future? Today, We're diving deep into the true cost of high-interest debt versus investing, and which should come first in your financial journey. Let's start with high-interest debt. Imagine you have a credit card balance of $1,000 with an interest rate of 20%. If you only make the minimum payment, you could end up paying over $1,200 in interest alone over time. That's a hefty price for borrowing money, isn't it? Now, let's shift gears to investing. If you were to take that same $1,000 and invest it instead, assuming an average annual return of 7%, you could potentially grow that money to over $1,400 in just 10 years. That's the power of compound interest, your money working for you. Alright, now let's zoom out. What if you're juggling both? Should you tackle your debt first or start investing? It really depends on your situation. If your debt is costing you more in interest than what you could earn from investments, it might be wise to prioritize paying it down. But here's a quick recap. High-interest debt can drain your resources, while investing can build wealth over time. So, ask yourself, what's your priority right now? Before we wrap up, I want to hear from you. What strategies have you used to manage debt or start investing? Share your thoughts in the comments below. Remember, your financial journey is unique, and understanding the balance between debt and investing is key. Thanks for joining me today, and don't forget to subscribe for more insights on making finance chill and relatable. As we wrap up, let's reflect on the true cost of high-interest debt versus investing. Here are 5 key takeaways to consider. High-interest debt can snowball quickly, making it hard to escape. Investing early, even with small amounts, can lead to significant growth over time. The average stock market return is around 7 to 10% annually, while high-interest debt can exceed 20%. Prioritizing debt repayment can free up cash flow for future investments. Finding a balance between paying off debt and investing is essential for long-term financial health. Remember, financial freedom is a journey, not a sprint. If you found value in this video, please like, share, and subscribe for more insights. Stay tuned for our next video where we'll explore budgeting strategies that actually work. Until next time, keep it chill and financial.